Now that you've had a chance to think about what your real driving force is, it's going to bring us back to where we are, back to the beginning, where we're starting this journey together. And that's going to lead us into the stock chart. Remember, my goal is to help you achieve your goal, which is ultimately to put cash into your bank account through trading. And so to get there, again, we're going to get clear on the journey. That is the destination. That's our why, what we're really using to drive us there. And we're going to get clear on where we're starting and then ultimately this journey in the middle. And so as we start to look at the journey in the middle, it's going to look a lot like this. To trade profitably, you must be able to read the stock chart, you must be able to pick a direction, and you must be able to apply the right strategy. So as we start to talk about that, that's going to lead us right into the stock chart. If you're going to learn how to pick a direction, you've got to be able to read the stock chart. The stock chart is where everything begins. This picture that you see on the screen right here, this is a stock chart. For those of you who've never traded before, this is a picture that you're going to get very familiar with. Let me take a few minutes and introduce you to the details of the stock chart. The first thing you need to know about a stock chart is simply the plotting of the past performance of a stock. In other words, we're going to take all that historical information that has happened and we're going to put it onto the screen. The reason this is beneficial is because it provides a visual representation of the price where people choose to buy and sell the individual trade. And ultimately, the buying and the selling pressure is the way that we're going to make money with our trades. Ultimately, what this buying and selling location reveals to us is how the other traders feel about the individual stock that they're looking at or they're trading. Now, this word feeling, I've put it in italics because it's an awkward word for a lot of people as they think about trading. Most people tend to think about trading as just a series of A plus B equals C. But the truth is, effective trading really is more of a study of human psychology than anything else. And psychology is all about feeling, how individual traders feel about the stock that they're looking at. So you say, well, why would this chart matter? Well, here's why it would matter. Because it allows us to study the historical behavior of a stock. Now notice that word, behavior. Looking at the stock chart allows us to study the historical behavior of a stock. Why is that important? Well, here's why. Because studying the historical behavior will help us better predict the future behavior of what a stock might be choosing to do in the future. Now, notice these key words. Notice what I am not saying. I am not saying that past performance is indicative of future performance. I'm saying historical behavior will help us better predict future behavior. It's a very distinct word and it's very specific because what we're studying in our charting analysis is the study of human behavior. This does not mean that if a stock went up 50% last year, it's going to go up 50% next year. That's historical performance being indicative of future performance. But what we can say is if a stock tends to find buying pressure here or tends to find selling pressure over there, then oftentimes that behavior will be repeated in the future. And so that's what the stock chart study allows us to look at. And as we think about human psychology and trading psychology, the stock chart is the only means that we have of recording and tracking that trading emotion or that human emotion as it's revealed in the price action. You can look at all the fundamental information you want to. It never tells you how people feel about a stock. You can look at a stock and say, well, why is this stock going up? You know, it has horrible earnings. Well, the people feel like it should go up, they're going to drive the price up. Or maybe you look at a stock and you say, why is this stock going down? It has great fundamental support. Well, if the people don't want to get behind it, then that stock's not going to go higher. And so what we're studying in the price chart is we're studying that trading emotion. So let's talk about how we read a price chart. Every price chart is going to be made up of 4 key price points. They are the open, the high, the low, and the close. The open is going to be the opening price of the day. So whenever you look at a stock, it opens trading at a specific price, and whatever that price is for the day, that's the opening price of the day. The high is the highest price at which the stock trades during the day. The low is the lowest price at which it trades during the day. And of course, the close is the last price that the stock trades before the close of trading session. All right, these 4 key price points make up every stock chart, and every stock in the market has these 4 4 price points every day. There may be a lot of fluctuation or there may not be very much, but every stock is always going to have all 4 of these key price points. So now let's talk about the way that we display this data. There are 3 main views of how we look at these 4 key price points. The first one is what we refer to as a line chart. The second is a bar chart. And the final one is what we call a candlestick chart. Let's look at each of these in more detail. The line chart is going to be your most basic form of charting. You've seen these all over the internet and on television, on Google Finance or Yahoo Finance or on CNBC. This is the most basic form of charting. It's just simply taking a line and drawing a line connecting all of the closing prices of the day. And that's all it is. It's just going to plot the closing price on a graph and draw a line from point to point. It's the most basic form of charting. Let's show you how it works here. Let's say you've got several price points across the screen, and these are all the closing prices for the day, whichever day it is. And all you do is play that little game that you did in kindergarten, connect the dots, and boom, there's your line chart. Now again, all of you have seen one of these. It's pretty basic. If you were to not have a hand-drawn version, but maybe a computer-generated, it would look something more like this right here. Very basic line chart. And the line chart is very beneficial for a few reasons. It's simple, it's clean, it's easy to see all of the information there. It's easy to see price patterns form. It's great for line drawing, which is where we come into our support and resistance, which we'll talk about in the next class. But all things considered, even though it's easy to see overall information and overall direction and whatnot, it's a little bit challenging because it does not show us all of the 4 price points. It only shows that closing price point. Consequently, we don't see a clear reflection of market sentiment. And in and of itself, the line chart is a little bit difficult to trade off of on its own. So that brings us to the bar chart. The bar chart is going to be advantageous because it's going to encompass all 4 of the key price points. We're going to have the open, the high, the low, and the close. Consequently, it's going to be easier to see overall market sentiment, and it's going to allow us to make better trading decisions as we look at the data and as we interpret that data. Let's learn how we draw a bar chart. A bar chart is going to be constructed from left to right. And the first thing you're going to notice is on the left, you're going to have a little left hash mark. That's going to indicate the opening price of the day. Now on the vertical axis, you'll have the high and the low. You have a line going vertically here, and the top of that line represents the high price of the day, and the bottom of that line represents the low price of the day. Now on the right side, you're going to notice a little right hash mark, and that is the closing price of the day. So this first bar that you see here on the left, this has a higher close than open. The reason we know that is because the closing price is higher than the opening price, and that's indicated moving from left to right with the open, then on the vertical axis, the high and the low, and then of course the close on the right side. Now if you look at the next bar next to it, you're going to notice that this has a lower close than open. If you look at the little left hash mark, that opening price, then you look up at the high mark of the day, the low mark of the day, and then moving on over to the right, you have the closing price, and that closing price is lower than the opening price. So this is what we call a basic Western bar, or basic Western stock bar. Now if we take those bars and we put it all into a chart together, we get our bar chart, okay? So you can look at this and you can see that we've got the advantageous component of seeing the high, the low, the open, and the close. You get all that information there, but there is a little bit of challenge. If I put a real screen on here, one that's been generated from the computer, you're going to notice that it gets a little bit difficult to read. I mean, how do you tell if you've got a higher close or lower close? Those little hash marks get really, really small. And so that's the challenge that we've got with the bar chart. The weakness is you get a lot of bars, they get really confusing, and after a while they kind of start to run together. So that brings us to our third view, which we call the candlestick view. Now candlesticks come to us from Japan. They're a great form of trading. We often call them Eastern candlesticks or Japanese candlesticks, and the reason again is because they come to us from Japan. It's a very ancient form of charting that frankly predates even what we use here in the United States, or what we historically have used here in the United States. And so Japanese candlesticks are great tool. As you work with them more, you're going to love what you can get in terms of information from the candles. But on its most basic principle, it's still just those 4 key price points: the open, the high, the low, and the close. The benefit here the candlestick brings is the fact that it adds color to the bars. And that color is going to make it a little bit easier to disseminate whether it's an up candle or if it's a down day, whether it's a higher close or whether it's a lower close. And so you get the benefits of the bar chart, but you have that added clarity of color. Let me show you what it looks like. Over here on the left, you see a typical bar where you've got the open, the high, the low, and the close. And then if you look over to the right, kind of in the middle here, you see a white candlestick. This is a candle variation of the bar that you see on the left. And what you notice here is you notice that the white candle body simply encompasses the open and the closing price, whereas on the vertical axis, the high and the low remain the same, just like they would on a bar chart. Okay, so you notice that the only difference here is that we've drawn the candle from the bottom up, from the open up to the close. Now, if you look at the next candle over, this is the opposite. This is a down candle where you see the close has been drawn down. And we shade that candle body with black because it's a colored candle or a full candle as opposed to a white open candle. Okay, so we kind of refer to it as a bearish candle. A black candle is more of a bearish candle. A white candle is more of a bullish candle. The open and the close disseminate or determine, I should say, the candle body, but the high and the low are going to be just like they would be on your bar chart. Now, if we put this all onto one chart together, it would look something like this, and you can see easily whether we've got a higher close or whether we've got a lower close based on the candle body variations. If we put this into a computer-generated chart, take a look at this. Very nice, clean chart. You got nice, clean white and black candles. It's literally black and white. Very easy to look at and easy to read. And so if there's a lot of reasons why we prefer the candlestick chart. Number one, it allows us to see all the price data, the open, the high, the low, and the close. But the colors make it easy to identify what it is that we're looking at. And then there's also something we call candlestick patterns. You're going to learn about that later when we get into the Level 2 program. But candlestick patterns offer incredible insight into trading sentiment. And once you start to interpret that data, you're going to have a very, very good idea of what the traders are thinking, how they're feeling, and when this stock may be shifting moving forward. And ultimately, as you think about candles, you're going to find why this is our preferred format of looking at the data.